In a recent Wall Street Journal op-ed, former World Bank President David Malpass addresses how he thinks the Fed can boost economic growth. He says it comes down to four things. Here they are. The central bank must shrink its balance sheet, stabilize the dollar, get capital flowing, and speak out about fiscal profligacy instead of totally greasing the skids and enabling fiscal profligacy, which some people would say that's what we've seen in the last 10 years.
Yeah, it's worrisome. You know, the Fed basically has become now just a giant hedge fund. It's lost $1 trillion, and counting. It's going to be a gigantic loss. What it does is borrows money at 5.4% from banks and then dumps it into government bonds. So think what that trade does. That causes the government to think that it's better off than it is. And so that encouraged the government to be short when rates were zero. So why did the government borrow so much in T-bills? Well, because the Fed was buying the bonds and it made it look like yields were going to stay low remember the low for long phrase. So we've got these multiple problems that are going on, and it endangers the dollar. So that's the basic case.
Instead of the Fed having such large balances, wouldn't the private sector be starting businesses and risking capital and bringing returns and adding to growth? Wouldn't all that money be better if it wasn't with the Fed?
That's right. And we're depending on private equity. So as the banks get squeezed out, because they're lending so much to the Fed, it's literally a floating rate loan from banks to the Federal Reserve so it can buy government bonds. So if that were freed up, that would allow the banks to at least consider a small business loan, an inventory loan, the kinds of things that help the economy grow. And this is on a global basis. It's not just the Fed. It's all the major central banks doing the same thing, meaning taking money from the economy in order to buy government bonds. We need to be clear on that. I heard the previous segment, they talk about money printing. There isn't any money printing on it. It's just money borrowing, and they pay top dollar for it. The Fed pays 5.4 to banks and 5.3 to money market funds, so to the Fidelity and Vanguard and so on.
You think that the Fed has a big role in helping us with growth, and that's the only way out of this mess?
It shouldn't have it shouldn't try not to do harm, and that means to allocate capital to government is going to slow global growth. So we have this problem facing the world of growth forecasts going down into 2024. The population is going up. The fragility of the world is getting worse, as we see all over the world. Refugee flows are increasing, and that comes back to that the world should be making enough capital, enough profits in order to grow the global economy, and it's just not doing it, in part because so much of it is going to government. A big problem is the government always gets first dibs on every dollar that anybody earns. If they want to borrow it, they're the lowest cost borrower in the whole world. So if the U.S. government wants to borrow $60 trillion, the world will step up and say, where's my chance? And that is really harmful to the business climate because you're altering the risk-return ratios.
You say a lot of similar things to Judy Shelton when she comes on. Do you familiar with her take on things?
Oh, I know her, and so
how do you differ?
Well, she's talked about the gold standard. I think we need to use gold as one thing to look at for the Fed to see when it's maybe off track.
But just in terms of the
interest rates,
being the fiscal and authorities and the Fed being attached at the hip.
Yep. So the Fed is way too big. It's also, we haven't talked about, but the regulatory policy aspect of the Fed is dominant. You know, it didn't used to be that the Fed was the major regulator. There were bank regulators, but now the Fed is the dominant bank regulator. So they're basically doing two things. They're deciding how much to pay banks and then how to regulate banks at the same time. And so that's really a conflict of interest and so I think the answer is one of compromise. Just bring down the balance sheet a lot. There's no reason why the Fed needs to have such a giant balance sheet and make such a big bet on the government. It's not fair to the people to have the central bank making this, it got all the way up to $9 trillion. It's come down a little bit, but not fair to have an agency of the government making a bet on the government.
How would, I mean, if you abolish the central bank?
I didn't say abolish.
Do you need a Taylor rule? Do you need rules?
For one, you need some restraint by the Fed to recognize that it shouldn't be.
Well, it's a different guy. It's a different guy or gal every couple of years. I mean, you would need some type of something written down that people have to follow, wouldn't you? In
general, I think the Fed and economists should agree that the central bank shouldn't be buying maturities beyond 3 months. It's okay for the central bank to own Treasury bills. They can borrow from banks and put it into Treasury bills, and that's kind of an arbitrageable situation. But for them to decide whether to buy a 5-year or a 9-year bond off the run or a 10-year bond, how does the Fed know how to do that? So it's not an issue at all of abolishing the central bank. It's saying that they've gotten way too big and are being followed too much by all the financial markets. They shouldn't be in the middle of all this. I'm also concerned about the inverted yield curve. I mean, think of the oddity and the harm in finance of having a 5.5% Fed funds rate or policy rate and going all the way down into the long term. It helps the rich and it hurts people that want to borrow floating rate. So all the little guys around the world are, not just in the U.S., but worldwide, have to borrow at the short end, whereas wealthier people can borrow at the long end. And so it's just not a balanced situation. And as I argue in the Wall Street Journal article, easy enough, or not easy, but the Fed can engineer a course out of this simply by saying, look, we're going to defend the dollar by allowing some of our balance sheet to burn off. It's already doing that, but have it burn off faster.
Well, from a previous conversation, let's not have it burn. We don't need any more. We don't need more emissions. People are dying. People are dying. I heard that yesterday.
Let it mature and shorten the maturity of the balance sheet.